Hello and welcome back to the ROI channel, the return on investment channel. Today, going to do a bit of an analysis. My YouTube is not as frequent as I would like it to be, but I'm prioritizing the Substack. So make sure that you check out the link in the description. And I think it's also good to have a little bit of patience instead of I'm guilty as much as the next person of binge consuming certain content. And I think that really places our focus on the short term, which is not where it should be if, well, for those of us who are long-term value orientated. So enough said. Ramaco Resources, first off, credit to our friend Stephen Farrington from the Unemployed Value Degen. His details will be in the description. He sent me a DM on Twitter and said you might like Ramaco's spin out because there's a royalty attached to it. So we got coal, we got royalties. Life's looking pretty good. I initially passed on Ramaco for reasons that I'll get into. The ROI Club, guys, subscribe now. And there's free option. There's a super cheap option, which will be annually. I've merged the Maverick Life into the ROI Club. So there's a ton of great content out there. It'll be super expensive if you want to pay monthly. If you want to commit to a year, it's cheap as chips for the return on investment. So that's that. Disclaimer, nothing I say here is advice, of course. And we're going to get into the useful stuff, hopefully. So Ramaco Resources, it's a met coal company in a good jurisdiction. Okay, so met coal, our friend Trader Ferg talks about the big addition rather than the big substitution in terms of energy sources. In the developing world, thermal coal and metallurgical coal are both going to be important. I believe the margins on met coal are likely to be better, and they will continue for longer periods of time, in my opinion. So that being said, this is a small cap coal company, okay? And if you remember an episode of me talking with Uncle Rick said he was avoiding the smaller cap, like sub 4 billion, 5 billion, in his words, coal companies, because if they run into trouble, that sector is sector non grata and cannot attract new capital. And it's a good idea. This changes things though when we're talking about a spin-off that's got royalties attached to it. So we're gonna look at that. I think it is exceptional. Core assets, the core assets are like carbon or rare earths. It stands for some catchy slogan in the presentation. Coal infrastructure, rare earth element royalties, and carbon intellectual property licensing stuff. I'm not particularly keen on carbony, the carbon flavor of the world, but intellectual property, I am. This company CEO, he bought a new coal mine and he accidentally really found this massive rare earth deposit. So very interesting. I'm not going to embarrass myself and try and talk about rare earths because I don't think anyone really understands rare earths, to be honest. But I do know they're important, and being outside of China, who control really the rare earth market, at least at the moment, is going to be very important later down the track. So 20% payout expected on the net income. They will not they're good stewards of capital, so they'll adjust the payouts according to the maintenance and growth capex that's agreed upon, which is good. They're not going to be borrowing from Peter to pay Paul, in layman's terms. So you've got two ways to play, or three really. I've taken a screenshot from the 10Q. I just thought it was interesting. So METC is the operational aspect, so they're the operator. Wonderful. METCB is what's been spun out. And this is the theme. If you read the white paper that our friend James Davolos has done, I can make that available if you ask me for the password. This is where companies have their own royalty portfolio inside their operational company, and they feel that they're not getting valued appropriately because people are kind of missing them. And so they're spinning them out. So Venom would be a great example, Prairie Sky Royalties, the list goes on. So there we go. Carbon or rare earth is what the core royalties stand for. And they have non-cost bearing royalties. This has been a theme I've been banging the table on for some years now. Okay. So their income will be tied to coal prices and production growth, which is good. They do not have the downside of increased expenditure, and they have some pipeline fees, rail fees, transport fees. It's a beautiful Warren Buffett type business. Okay, we've got potential upside from the rare earth elements. I have no idea what's going to happen with that. I think it'll be big if this company can survive for years and years, which I think it can. And I think I'm just treating this as a pure lottery ticket. Here's where I take some issues. So Class B common stock, dividend associated with a forward yield of 9%. Um, I'm not sure exactly how they were calculating that because I'm looking at the stock price and it was a lot higher than where it is today, which is a good thing for me as a buyer. The dividend yields, we'll get into it. Underneath here, you've got your Class A stocks, that would be METC, Class B, that would be your METCB, and there are, if you wanted to buy some bonds, you could get paid 9% on a, in my opinion, a pretty good deal, pretty good company, and get paid back in 2026. I suppose the issue with that would be if this company went into some sort of liquidity event, which, given its net cash, I believe it's not really going to be a big deal. But there's another way that no one's talking about, and I thought that I might share it just out of interest. I think for this one, you're playing it for the upside, and this is the upside. So in a nutshell, they're looking to double their production, okay, over the medium term. I don't know what they're defining as a medium term. So, I would say 3 to 5 years in my mind is medium term, but hey, we want to keep an eye on that. Doubling production. Um, I certainly think it's possible, and I certainly think there's a market for it. And this is what I was talking about. So our one-page company overview, 52-week high was basically double from where we are today. And the yield today is expected to come in around 4.5. I think it depends on the met coal pricing that they were using. So there's that. Let's get into what we really need to do more of as investors, which is really just get into the 10Ks and the 10Q filings and read as much as we can. This is what we're looking at. So these are the revenue. Okay. We need to go to the Class B if you're interested in the Class B. Okay. In my case, that's what I'm interested in. So I'm looking here and I'm going 6 months, 40 cents, and fully diluted earnings is expected. So I'm making that cardinal sin of finance and I'm annualizing it. So in this case, it'd be doubled. So 82 cents a year earnings would be expected at current production and current prices. Okay. And what I would like to point out here, look at all these costs and expenses. Moving into the future, it's my understanding that basically none of these will be the responsibility of the METCB or the Class B shares because they've got royalties. Ta-da! How good. So we can have a global event where everything gets sold off indiscriminately. We can have, for whatever reason, 1 or 2 years of soft met gold prices. I believe we're pretty much at the trough, but you never know. It's commodities we're talking about here. And the beauty of this is as long as they actually have a senior claim on the asset, and that's a big thing that James and the guys at Horizon look at. So you don't have exposure to all these expenses. You might have a drop in revenue if we have a nasty patch for a year or 2 years, 3 years, who knows what. You're still going to get paid something, and your downside is all but taken away. So I will move the window out of the way, and we can see that the common divvies are based on, or the Class B, I should say, are based on 20% of the previous quarter royalty and infrastructure fees. So you've got no downside, but you've got a big participation in the upside of volume, price, and if they discover an increased efficiency model or ability to increase the life of the mines, which at the moment are fine for what you're paying. Here we go. The royalty aspect is here. Infrastructure fees are here, and they actually give you what their fixed fee structure is. So we've got an infrastructure company hiding as a royalty company, masquerading wrapped up in a coal wrapper. So no one is going to want to touch this really until they work out how much money I believe it's going to make. That's my opinion. So we're looking at total cash available for the Class Bs as a dividend down the bottom here. That comes out of where? Well, usually we're going to look at the core royalty and infrastructure fees for the quarter. And again, I'm annualizing it based on last quarter's production and met coal prices. Okay, done. Simple as that. 42 million annualized doesn't seem like an awful lot when you look at it, but I believe that could easily double if you double production and you get coal prices back to where they were only a year or two ago. All of a sudden, you could have a few absolute windfall years. The difference between now and back then, there are two differences. Now the operating companies don't have nearly the balance sheet problems that they did, the ones that have survived. And two, you're not on the hook as a royalty owner for any of the expenses anyway. So I think that there's a tremendous upside to this company. It's not necessarily reflected today. You got to think 18 months, 24 months into the future. So I'm breaking it down to a per share basis to make it simple and a little bit oversimplified, I suppose. Free cash per share, earnings per share, it's going to be more or less the same thing in this particular company due to the operating model. I'm applying 8.5% yield. You can agree, you can disagree with that. Okay. Given the repeatability, the sustainability of the earnings, this should be like 20, but it's coal and it's a small cap. So we need to back off the assertiveness or the aggressiveness of our assumptions. So it's trading roughly what we'd expect it to trade at, roughly a fair value today. But you remember, we've got all this call option upside, not only on the rare earth deposit, that'll be in the future and whatever happens, happens. But with regards to the coal, the increased production and the increased price, most likely will fall straight to the bottom line of this company. And I can foresee a couple of years where you may have the entire market cap of this METCB class shares paid back to you in dividends over the course of maybe 2 or 3 years. So what might that look like? I'm going to go super rough here, and I'm just simply going to say double production in a healthier price environment. We can get 100% on the upside in terms of the earnings. It's rough, but I believe it might even be conservative. Okay. And remember, this would be for 1 year. So the company ticks away, it does its good job, we're paying fair value. We get to a point, maybe in 1 year, 2 year, 3 years, where it has a bumper year, it reaches double production, it has a good pricing year. Free cash per share could easily be 1.6, earnings would be roughly the same. I'm keeping it an 8.5% free cash yield, so there's no multiple expansion embedded in the expectations, and you'd be looking at basically a double from here. And so what would that be as a dividend yield? Well, if we're expecting 20% paid out straight away as a divvy, then obviously you got about 32 cents per share as a dividend. And, you know, you've got a really good equity upside kicker. I think that that's quite attractive. So I'm in accumulation mode for this. I'm not going crazy, but I've got about 2% of the public portfolio in this particular company. I've got almost 2% in the Maverick Life portfolio, which you can access as a premium member to the Substack. And again, in another private wealth portfolio, it's weighted at roughly 2%. And I would love to add to it over time. So that being said, there are my thoughts on Ramaco. I'd just like to make a few little comments around the eToro portfolio. The reason is it's a public portfolio that everyone can access, and it does reflect to a large degree what I do privately, but with a few little nuances. So made some mistakes in 2022. The mistakes I made were not backing myself, was letting other people influence me, and there we go. So I had a very ordinary year. The next year, when I said, no, stop this, I'm going back to just trusting my judgment and my research, had a bumper year. This year's been up, it's been down, it's been up, it's been down, and that will be absolutely standard in a deeper value portfolio. And the return over the 2-year period is about 18% annualized. So not bad. What I'd like to point out here, this illustrates perfectly my mental model for a barbell. It's not the Nassim Taleb barbell or anything like that. It's I want to be in value. I want to be in resources because the rotation is coming. We need these things. We've got money debasement and we've got a dearth of capex. That's the key bridge between where you see monetary policy ending up in inflation, in my opinion. You've got your high quality inflation beneficiaries. So your Texas Pacifics, your Lambridge, your Wheatons, they all reflect that. And lo and behold, they're the biggest performers so far year to date. And so there's a lot to be said for just buying damn good companies, damn good operating or business models, those that can generate revenue, that have a hard asset interest that can benefit to the upside without a commensurate expense or risk on the downside. They are the premier examples of that. Then we've got special, it really is a special situation, but I think it's going to work. Your deep value, so your offshore, where you're buying at both a discount to asset value, and now you're actually buying at a discount to expected cash flows. It's a very rare phenomenon that I don't think is going to last. That would be your Valarises, that would be your Warriors. Transocean to net asset value, it's not turning cash yet, but I believe that it's imminent. The only question marks here for me, my reflections would be about position sizing. I saw Venom and I loved it, and yet I only put 3% into it, which doesn't make an awful lot of sense, really. I should have gone a little bit higher. I suppose you could argue I was already heavily exposed with Texas and Texas Pacific and Lambridge, but it is what it is. Special situations around Sabanye, you all know my thoughts there. And perhaps I could have taken a little bit away from Warrior, but again, I think the things are double in the next 2 to 3 years. We have the plans in place. And so I'm not particularly worried. Valaris is heavily weighted. So if you go through a soft sentiment cycle, really is what it is. Nothing's changed in, well, nothing negative has happened in the offshore space with Valaris and Transocean. It's just the price sentiment has been sold off a little. But because they're a higher weighting, that does affect the overall portfolio. And you can see here high quality businesses, Sandstorms, Royalty Pharma, Franco Nevada. The Chinese stocks I've kept to a low exposure, but I want a little bit of exposure to China. They've done exceptionally well in such a short time. And then we've got our silo two, really, of inflation beneficiaries, which will be the exchanges, and a way to play crypto without owning crypto, the exchanges, because the volumes and the on-ramping for crypto will happen, and it'll become more and more legitimate trading through exchanges. So there's that. There's not an awful lot left really to talk about, guys. It's sit back and bear the volatility. If you can dollar cost average, great. If not, just sit back and relax. Things are going pretty well. That's it. Thank you very much for watching. Make sure you check out the links in the description. Any comments or questions, be sure to hit me up. And I look forward to catching up with you in another episode in the future. Take care.